Welcome to Business Line's State of the Economy podcast, where you'll find insight, analysis, and the story behind the numbers.
Namaskar. My name is Shishir Sinha. I work with the Hindu Business Line in New Delhi. The government released 4 high-frequency data and 1 low-frequency data during last 2 days. Various data are suggesting various things about the economy. To get more about these data and to get the nuances of these data, we have with us Rajani Sinha, Chief Economist with CARE. Rajani, welcome to the show.
Thank you, Shishir.
Now, my first question is that when we talk about GDP data, the government says that the momentum is there. But when I talk to experts like you, there is a opinion, there are opinions that it has slowed down. What is your take on that?
So if I look at the GDP data, firstly, the important thing to note is that the number here has to look at from the perspective that the last year's number has been revised upwards. So the Q3 FY23 number looks lower than what most market participants were expecting because of the upward revision in last year's number. But nevertheless, if I look at it, comparing with the last year's revised number, what is concerning is the continued contraction in manufacturing sector. While one can say that it's not strictly comparable because this number is the first estimate, whereas the last year's numbers is revised estimate. Anyways, but we have to do that comparison with the data that we have available. And that shows that manufacturing sector has been contracting, which I would say is concerning. It was anticipated, but I would say the contraction is more than what we have, we were expecting. And there's a combination of reason which is contributing to this lower manufacturing sector growth. One is obviously the global demand has slowed down, which is also getting reflected in the exports data. Secondly, even the domestic demand, we are seeing some fizzling out of the pent-up demand that we had been seeing in the last few months. Even inflation is having a bearing on the manufacturing sector growth. So I would say overall, it's a slowing down of domestic demand as well as global demand that is resulting in manufacturing sector slowdown. And not just the GDP data, this is also getting reflected in the corporate sector performance. If you look at the Q3 number, quarterly results that have been announced by corporates, we had done an analysis of some 2,200 listed companies, aggregate data and what does it look like. And what we find is that sales while it's still recording a positive growth, but it has decelerated sharply in the third quarter. So definitely pent-up demand is slowing down, even while, yes, global demand is also slowing down. And that is concern. For manufacturing sector, the other thing which is going against the sector is that the expenditure is still high. So even while raw material prices have gone down in Q3 when compared to Q2, but it's still high when you compare it to last year. And not just raw material cost, we are also seeing employee cost and interest cost going up. Mm-hmm. So that is also having a bearing on the operating profit of corporates.
Rajni, one thing what we have seen almost 6 revision in GDP number. And it is very difficult to compare what we call as the apple versus apple or apple versus orange. So you rightly mentioned that when we talk about Q3 number, which is the advanced estimate for fiscal year 22-23, and if we take the 21-23, it is the first revised estimate. So comparing the number which are revised estimate and the advanced estimate, very difficult one. What will be your suggestion to the MOSPI as well as to the government to make the data comparable?
Shishir, that's a very difficult question. I don't know if there is a solution to this because see, the whole idea of data being revised is because there is some data which comes with a lag and hence this revision happens. But at the same time, if the revision is so sharp, it does through the whole fiscal policy and monetary policy, it becomes very difficult. How do you form a view? How does the government or central bank form a view based on the latest data when there are chances of it being revised upwards or downwards very sharply in the next few months? So this is a big challenge. I don't think there's a simple solution to this. Yes, one way could be that we read more into the high frequency indicators and try to kind of decipher from high frequency indicators also as to which way the economy is moving. But there again, the problem is that for India, we do not have many high frequency indicators, unlike some of the developed economies like US, where we have much more of high frequency indicators. In India, we have limited high frequency indicators that we can look at. But yes, the only thing I can think of is then we focus also on what the high frequency indicators are showing. And in fact, talking about high frequency indicators, we have created an index based off 18 high frequency indicators, and we track that on a monthly basis to see how, what are the high frequency indicators showing. So as per that index of high frequency indicators, what we are seeing is that there has been a sequential slowdown in the month of Jan. Our index is at a 5-month low in Jan. Though on a YOY basis, the index is still recording around 11% growth, this aggregate index of high frequency indicators. But on a sequential basis, it is at a 5-month low in Jan. It is because of, various high frequency indicators are also showing a slowdown. For instance, PMI manufacturing and services, though it's still in the expansion zone, but it has kind of, moderated. Exports and imports both have slowed down. Various high frequency indicators are also pointing towards a slowdown. At the same time, there are indicators, high frequency indicators, which are showing that things are not that bad. Like for instance, if I talk about IIP on a YOY basis, the last data point is showing a slowdown to around 4.7% or so. But if I remove the base effect and if I just look at the momentum effect, it is gaining in momentum. Overall, I would say it's still a mixed picture. It's not a very clear sign of slowdown.
Rajani, another issue is about the quarterly data. They are not the seasonally adjusted one. So is it difficult to get the true picture of the economy when the data are not adjusted according to the changes in the various elements?
Yes, definitely. I think going forward, some of the things that you're highlighting, government should look into it as to what we can do to make our data releases much more sharper, much more accurate, and making it easier for analysts and economists to be able to decipher from that data. And also for the policymakers. So but definitely it will help if we get the seasonally adjusted data too. Because now what's happening is everyone is doing their own adjustments and own analysis, and we could be missing the big picture. So yes, it would definitely help if we also get the seasonally adjusted quarterly data.
Now coming to the two components of the GDP number, one is of course the PFC, private final consumption expenditure, and the second one is the manufacturing. Let me first talk about the PFC. If we take the number for Q3, it is around 2%. If we take the imputed number for Q4, it is 1.5%. Does this mean that the private final consumption, or rather in a very simpler word, we say demand is slowing down?
I wouldn't say so, Shishir, because private final consumption expenditure, the Q3 data that we have, is also getting adversely impacted by the base effect. So in our analysis, what we do is we remove the base effect and we look at the momentum and see what is happening to the momentum. Is that being sustained? And what we find is that for private final consumption expenditure, in fact, the momentum is being sustained. And the lower growth that we are seeing is mainly because of the high base of last year. I wouldn't completely say that there's been a sharp slowdown in consumption GDP in third quarter. The momentum is being sustained.
Okay, now coming to the manufacturing, the two critical factors are, of course, the one is the hike in interest rate by 250 basis points. And of course, the export slowdown. Which one will you give the more weightage among these two factors affecting the manufacturing as a whole?
Before I go to your question, I'll just highlight a third factor also. Yeah. I think we also have to take into account the fact that a lot of pent-up demand that we have seen in the last months and quarters, there could be some petering down of that. So we should also be ready for that. Now, coming to your question, I think, whether interest rate would be more critical or exports, that would really depend on, which sector we are looking at. A sector which is more export intensive, like say apparel, footwear, textile, chemicals, they would definitely be more impacted by the lower external demand, whereas many other sectors which are more, domestic dependent would not feel the feel the adverse impact of slowing external demand. As far as interest rate is concerned, I feel it is pinching the rising interest rate, but I don't think that should be a very strong factor pulling down, the corporate sector's performance or India's manufacturing sector performance. That's because, it also depends on how critical. Firstly, we have to appreciate that interest rate is rising from a very low level. So during the pandemic, interest rates had gone down to very low level. So it's rising from a very low level, but if I look at it in absolute terms, it's still not at a very high level. So that is not something which should be hindering the manufacturing sector, the private sector, from going ahead with their expansion plans. I think there are other factors which are more critical in terms of uncertainty around us, in terms of global uncertainty as well as domestic uncertainty, which will be more of a hindrance when it comes to investment picking up than interest rate. So interest rates have risen, but I think we should not worry too much about it because it has risen from a low level. And I think it has broadly reached its peak. Maybe another 25 basis point hike market has started factoring in because of the latest development. But now we can assume that it's close to its peak, if not already at its peak.
Okay, if you say it's close to peak, but at the same time, you also have to think about domestic demand because the export demand is not picking up and that is also affecting the manufacturing sector. Do you think that the time has come to pause the interest rate, even if we have a kind of one particular month of very high CPI rate, that in the month of January when we saw 6.52? Do you think that the time has come to go for a pause in April meeting? Of course, you said 25 basis point market is expecting, but will it be a wise move to go for pause and boost the domestic demand? Because at this moment, we should focus more on boosting the domestic demand because the export demand is not picking up.
I completely agree with you, Shishir. It's very important that we give a push and encourage domestic demand because definitely external demand is going to be weak in the coming year. But the central bank has a very difficult decision to make. If you had asked me this question a month back, I would have definitely said that RBI will reach its peak at 6.5% and stop at that. But what has happened now is that not just one number has come high. There's also, if you see what has been happening globally. Globally also, if I look at US Fed has, there also whatever the market has factored in, US Fed is conveying the message of being more hawkish than what the market had anticipated. So now globally also in the US market, the expectation of rate hike have been increased. So that is also something which will have a bearing on our exchange rate and on the decisions by our central bank. But yes, I agree that, one data point, and that data point is mainly because of high food inflation, cereal inflation. And going forward, the expectation, I feel that food inflation should moderate in the months to come. But the main concern for central bank will remain the sticky core inflation. But I think the difficulty for the central bank here is that if they do not go for another rate hike in the coming meeting, then probably they will not get the chance to hike any further. So that's something which would be playing on their mind. But having said that, I feel maybe the central bank should wait and see the impact of the rate hikes that they have made so far and then make this decision. But the difficulty is if they wait, if they don't hike it this time, it will be difficult for them to hike it later. So their main concern is that what if core inflation is a bigger demon than what we are thinking so far, because that's what we are seeing globally. And hence, I said that there are chances RBI has left that window open that if need be, they would hike by another 25 basis points. Okay. As far as growth is concerned, Shishir, I don't think central bank, even with the, data points that we've been getting, which are indicating some signs of slowdown, but this slowdown was kind of on expected lines. We were all expecting that FY24 GDP growth is going to moderate from FY23 level. For instance, we are expecting around 6.1% GDP growth, which I would say is not very bad given the global scenario in which we are. So I think at this point in time, the central bank would not be overly concerned about growth. They are definitely more concerned about core inflation. Hence, I said there are chances that they may hike by another 25 basis points.
Among the four high frequency indicators indicators which I mentioned in the beginning. Of course, we talked about PMI manufacturing. We talked about core sector data also. Another one is the GST number. The GST number is showing 1.49 lakh crore plus. For the month of February. Of course, it is bit lower than the January if you take the sequential number. But if you take the Y-on-Y number, it is 12% higher than the last February. One of the observation of the GST number is that it is not just the consumption, but inflation is contributing more in the collection. Do you agree with this kind of a statement?
So actually, it's a combination of both the things. The inflation is definitely giving a push to the GST number. So this 12% YOY growth number that you spoke about, around 6% would be coming from inflation and 6% would be the actual growth. So, but the point is that even if it's growing by 6% on a YOY basis, it is a good number. Even if I deflate the GST number and remove the inflation impact, if the GST collection is growing by around 5 to 8%, which would be the case if you remove inflation, I would say it's not bad.
Okay. Now, one final question to you, Rajani, about the growth forecast for this year and the next fiscal. There are various numbers. Of course, government is sticking to 7% for the current fiscal and then 6 to 6.8%, anything between 6 to 6.8% and 6.5% as a baseline scenario for the next fiscal. There are various observations about 6% for the next fiscal. But one thing which we have got is that this year 7% may not be possible, and even next year 6% will be a challenging one considering the global headwinds which India is facing. What is your assessment?
So what we had estimated was around 6.9% growth for this fiscal. But yes, given the kind of revision that we have seen with the last number, it becomes difficult to say whether, we will be able to get that kind of number, 6.9%. Because with the upward revision, it does look more likely that in the fourth quarter, we will not be able to get the number required to get 6.9 or 7% growth. So yes, there are chances that GDP growth could be lower than in FY23 as against the 7% number which the government has said. Talking about FY24, we expect the growth to slow down to around 6.1%. I would say the main concern comes from the global slowdown because the impact that it will have on our economy is not just through the exports channel, but also through various other channels like even investment or financing. So if I take all that into account and the uncertainty in business sentiments that it will cause in Indian economy also with the global slowdown, I think 6% looks more likely for FY24 than the higher numbers that the government is talking about right now.
Rajani, thank you very much for talking to the Business Line.
Thank you.